Ever thought about building wealth through dividend investing? Imagine this. You're a part owner of a successful company. Now, as a part owner, you're entitled to a share of the profits, right? This is the essence of dividend investing. It's a strategy where you invest in companies that distribute a portion of their earnings to shareholders in the form of dividends. But why should you consider it? Well, the beauty of dividend investing lies in its dual-source income. Not only can you potentially gain from the rise in the company's stock price over time, but you also receive regular dividend payouts. This can serve as a steady income stream, especially useful in uncertain market conditions. Moreover, these dividends can be reinvested to buy more shares, leading to an increase in your ownership stake and further dividends down the line. Sounds interesting, doesn't it? Let's dive deeper. First, understand what dividends really are. Let's dive right in. Dividends are essentially a portion of a company's profits that are distributed to its shareholders. Picture a pie, representing a company's earnings. As a shareholder, you own a slice of that pie. Dividends are like a cherry on top of your slice, a sweet bonus that the company offers you for holding onto their stock. Now, not all companies give out dividends. Some prefer to reinvest all their profits back into the business for growth. These are typically younger, high-growth companies. On the other hand, well-established companies with steady profits often distribute dividends. These are the ones dividend investors seek out. But why are dividends important? Well, they play a significant role in your overall return on investment. Imagine you buy a stock at $10 and sell it later at $15. That's a 50% return, right? But what if during the time you held the stock, it also paid out $2 per share in dividends? Now your total return jumps to 70%. That's the power of dividends. Dividends not only provide an immediate return, but also offer a cushion during market downturns. When stock prices fall, dividends can help offset some of those losses. And if you choose to reinvest those dividends, you can buy more shares, which can potentially lead to even more dividends in the future. It's a cycle that can help your wealth grow over time. Another beauty of dividends is their consistency. Many companies aim to pay stable and gradually increasing dividends over time. This can provide a predictable income stream, which is especially attractive if you're planning for retirement or looking for regular income. So, dividends can be a steady stream of income. Now, how do you get started? Getting started with dividend investing isn't rocket science. It's a journey that begins with a single step: understanding your financial goals. Do you want a steady income stream, or are you looking to grow your wealth over time? Your answers will guide your investment choices. Once you've outlined your goals, it's time to roll up your sleeves and do some research. Your mission, should you choose to accept it, is to uncover companies with a history of paying consistent dividends. These are typically well-established companies in sectors like utilities, healthcare, and consumer goods. But remember, past performance is not always indicative of future results, so dig deeper. Look at their financial health, competitive position, and future prospects. Next, it's time to buy shares. But how much should you invest? A good rule of thumb is to only invest what you can afford to lose. This isn't a get-rich-quick scheme. It's about building wealth over time. Once you've purchased shares, you'll start receiving dividends. You can take these dividends as cash, but the real magic happens when you reinvest them. By reinvesting your dividends, you're buying more shares, which in turn generate more dividends. This is what we call the snowball effect. But wait, there's more. It's not enough to just invest in one company. That's like putting all your eggs in one basket. The key to successful investing is diversification. By spreading your investments across different sectors and geographic locations, you can reduce your risk and potentially increase your returns. So, to recap, set your financial goals, research companies, buy shares, reinvest dividends, diversify your portfolio. It's a simple process, but it requires discipline, patience, and a willingness to learn. With these steps, you're on your path to dividend investing. But how do you pick the right stocks? Well, that's a conversation for another scene. Stay tuned! Picking the right stocks is crucial for dividend investing. Now that we've established this, let's dive into the criteria for selecting dividend stocks. To start, let's discuss dividend yield. This is the annual dividend payment divided by the stock's price. It can be a great way to compare the relative attractiveness of different stocks. A higher yield may indicate a better bargain, but be cautious. A yield that seems too good to be true probably is, as it could be a sign of a struggling company. Next up is the payout ratio. This is the percentage of a company's earnings paid out as dividends. A lower payout ratio could mean the company has room to increase its dividends in the future. However, a higher ratio isn't necessarily bad. It might just mean a company is generously sharing its profits with shareholders. Now let's consider growth. Dividend growth is a clear indicator of a company's financial health. Companies with a history of increasing dividends are likely to continue doing so. This growth can significantly compound your returns over time. Stability is another important factor. Companies with steady earnings are more likely to pay consistent dividends. Look for those with a long track record of reliability, even in challenging economic times. Now, let's introduce the concept of dividend aristocrats. These are companies in the S&P 500 that have not just paid, but also increased their dividends for at least 25 consecutive years. They're the cream of the crop when it comes to dividend investing. It's also worth mentioning that while these criteria are important, they're not the be-all and end-all. Each investor has unique goals and risk tolerances, so what works for one might not work for another. Armed with these criteria, you can make informed decisions. But remember, patience is key. It takes time for dividends to compound and grow, but the wait can be well worth it. So stay the course and let the power of dividends work its magic. Compound interest is your best friend in dividend investing. Imagine a snowball rolling down a hill. As it travels, it gathers more snow, growing larger and faster with each roll. This is the simplest way to visualize the concept of compound interest. It's the process of earning interest on your investment and then earning interest on that interest. It's about growth on growth, where your money makes more money, which in turn makes even more money. In the context of dividend investing, compound interest comes into play when you reinvest your dividends. Rather than pocketing the dividends you receive, you put them back into buying more shares. Each time you reinvest a dividend, your number of shares increases. This means the next dividend payout will be based on a larger number of shares, giving you a bigger dividend. And so, the cycle continues. This might seem like a slow process at first, but over time the growth can be significant. Let's say you invested $10,000 in a company that pays a 4% dividend annually. If you take the dividends as cash, after 20 years, you would have earned $8,000 in dividends. But if you reinvested those dividends, you would have over $22,000. That's almost 3 times the initial investment. There's an old saying that goes, "The most powerful force in the universe is compound interest." And while that might not be scientifically accurate, it certainly holds true in the world of finance. The key to successfully harnessing the power of compound interest lies in time and patience. It's not about getting rich quick, but rather about building wealth steadily over time. The beauty of compound interest is that it requires no additional work or effort on your part. You simply let your money do the heavy lifting. All you need to do is make the initial investment, set up a dividend reinvestment plan, and then sit back and watch as your wealth grows. So the magic of dividend investing lies in the power of compound interest. So, are you ready to build wealth through dividend investing? Let's take a moment to recap the key points we've discussed. We've learned that dividends are a portion of a company's earnings distributed to shareholders, offering a steady stream of income. We've also explored how to start with dividend investing, emphasizing the importance of starting small and gradually increasing your investments as you gain more confidence and understanding. We've delved into the art of selecting dividend stocks, focusing on companies with a strong track record of paying consistent dividends. And of course, we've underscored the power of compound interest, the snowball effect that can significantly amplify your earnings over time. All these elements come together in the grand scheme of building wealth through dividend investing. It's not a get-rich-quick scheme, but a steady, reliable approach to growing your wealth. Remember, dividend investing is a long-term strategy. Start today and see your wealth grow over time.